Welcome, dear friends. It's time for a little presentation, and today I would like to focus on this very important topic: the two necessary components of profitable FX trading. And let's get started. One commonly known fact is that a significant amount of forex traders fail. We know these numbers. More than 90% fail and lose money. And it should be understood that this group includes people who are very intelligent, very committed, okay, who have a lot of skills. So you know that this number is so high is quite shocking. But I would like to remind you why that is the case. Okay, so let's start with this one. Often on the internet you see people saying or writing these kind of phrases. Forex trading is 90% discipline. No, it's not. Even if you have perfect discipline, okay, like for example a robot, a trading robot, it has perfect discipline, it doesn't have greed or fear or emotions, that doesn't mean that you succeed, okay? In fact, most strategies will fail no matter how complex they are. We come to that in a second. And you also see people saying, well, you just need a true edge. Yeah, that's true. But again, that is not sufficient neither. You need both. You need both components, okay? You need the discipline and the mindset psychology on the one hand, but on the other hand, you need the real edge, okay? Something which actually works if your trading plan is implemented really well. And surprise, surprise, the true edge is the market causality, of course. But again, we come to that soon. All right? So the reason why so many traders lose money is because they are lacking either one of these two components or both of those components. It's not enough to just have one of them. You need a true edge, which is proven and works no matter what the market condition is, no matter whether the market is ranging or trending or whatever, and which works, over an extended period of time. That's why you need the market causality, the market structure. This is leading information. It's not a statistical system with some indicators, yeah? But then, of course, you also need discipline, yeah? If you implement trades, this implies that you have the discipline to trade well and not to gamble, so to speak, yeah? To have your risk under control, to not get carried away, to not get provoked by the market, etc. This is the reason why so many traders fail, no matter whether they're intelligent, whether they, prepare themselves, whether they have a lot of skills, it doesn't matter. They fall victim to either their emotions or they fall victim to the complexity of the actual price mechanism. So what's the solution? Well, regarding the edge, as I said, the market causality, obviously, and this is not a sales pitch or something, okay, you know that, but the market causality is the solution to the edge. Because surprise, surprise, the market moves against our money positions, the market conducts stop hunting, okay, the market follows the principles I've outlined in all these videos on this channel and in other places, yeah, such as the video course. This is how the market works. This will not really change, you see. And it doesn't matter what the market does, whether it's in a trending phase, within a squeeze phase, or whether there are position bars on both sides and it does some consolidation. It doesn't matter. The causality always is the reason why the price moves as it does. The price is the output. Yeah. But we also need to have a risk policy in place. Okay, we are still on the buy side. We are not market makers, we are price takers, so that means we need to have our risk under control, and I will talk a bit about the different ways of doing that, etc. So let's again talk about the first component, the edge. That's the reason why all this doesn't work. Okay, if you have indicators which are price based, on the internet you see thousands and thousands of them, they do not work consistently. Yeah, and thus, of course, indicator-based systems do not really work consistently. Commercial robots obviously do not work. Okay, they're often martingale-based and whatnot. Technical analysis in general does not really work consistently, but fundamental analysis neither in forex. I'm talking here, obviously. Yeah. So the price mechanism is complex, and the vast majority of my work, as you know, is focused on that point. Okay, the market causality I've shown here for several years now is all about why does the price move as it moves and what happens next. You can forecast the next price moves by understanding the causality and just by waiting for market structures where there's a high bias and you know what's going on. Like, let's say dumb money longies suddenly come into the market in euro dollar, like it happened in the last days, and you see all the green bars. Of course the price goes down. Yeah, you see the stops below the price, the stops get hunted. Yeah, I have so much content about that, as you know. So it's all about that. Okay, now that doesn't mean that statistical indicators are completely useless. Okay, you may have on your own MT4 some indicators just as a scope, let's say, on your gun. Yeah, so that you just maybe get an alert or an indicator, and then you check like what's going on in the market structure. There's a place for those tools. I use them also, but you cannot just trade price-based statistical signals. That doesn't work. It may work for a few weeks maximum, then the thing dies. Okay, no matter how good those signals look visually or on a quick visual back test, do not get fooled by that. Okay, what matters is where's the dumb money placed, where are the stops, okay, which dumb money groups get hunted next. That is the basis for predicting the next price moves very efficiently, and as you know, I've done so with a very high win-loss rate over a long period of time. Okay, just by sticking to clear market structures and trading them. This is also important. Do not spend a lifetime looking for the holy grail where you can rent it for a low fee per month. Again, this is not a sales pitch, but you know, if you can pay £54 per month, you know, and get access to these tools, of course, that's what you should do. Okay, there's no point in, you know, trying to get around that in any way, because, you know, for the vast majority of you to create something like this will take a long time. Okay, maybe a decade, maybe more, and it's not feasible for the vast majority of users here. So just, you know, I suggest put in the work. Okay, watch the videos, learn it, study the market causality, then once you're ready, subscribe. Okay, get the live shots, the live access, and then, you know, do some demo trading, and then, you know, you can go live and you will be a successful trader if you have both components under control. Yes, the edge, so being able to actually predict the next moves based on the causality, and now the risk management. And as I said, this presentation should be focused on the risk management because I talk so much about the edge in all the other videos. Yeah, we need, in trading in general, it's necessary. Okay, first of all, you need to respect the game. Okay, if you don't, you will lose. As simple as that. Patience, discipline, these things are essential in any kind of trading, and I can tell you, not only in forex, of course. Yeah, I mean, even if you are an order book scalper in futures, whatever, it's necessary that sometimes you just need to wait several hours and you can't do anything. Okay, you need to have the patience to wait for the right trades. You need to have the discipline to wait, to not over leverage. Okay, to be selective regarding your trades. This is a necessary component. Yeah, do not over trade. Just, you know, wait for the right setups and trade those, and do it in a professional manner. Remember, great traders are obsessed with risk. Watch, for example, the interview with Zoltan we made some time ago. Oh, we should do a second one, by the way, Zoltan. He is a good trader. He's obsessed with risk. He's thinking all the time, what can I lose maximum on this trade? Where do I cut all my trades? Where do I take a hit? The best traders are very focused on risk. Why? Because that's something they can directly control. You cannot control directly what your return will be or what setups you get, but you can control directly how much you can lose maximum. Okay, and if you read books such as Market Wizards, you will see no matter which markets those guys traded, yeah, or in which ways, which styles, the one thing they all have in common is strong risk management. So what does the risk management imply? All kinds of factors, including risk per trade. How many trades can you have open at the same time? What's your maximum drawdown you would accept? What's your position sizing? Stops hedging, I will elaborate on this now. How do you manage the trade? Trading stops, okay, general exposure of your account, okay, the portfolio level, trade rules, how do you manage news announcements, gap risk, etc. And generally speaking, okay, in forex there are only two options for you, okay. Either you use stops, and I know people generally don't like it, but actually if you ask me, it's the best way to trade, really, because you know you're taking out a lot of stress of your trading, and also you know you have an additional layer of protection. If you really do not want to use stops, yeah, then the only alternative really is to hedge. What does it mean? That means, let's say you sell euro dollar. If the price goes up against your trade, on the upper side of the trade you already put in a buy stop order for the equivalent amount of your trade, that if the trade goes too far against your forecast, you get filled and you are hedged, and you know your downside can't increase. Now obviously what you need to do then is you need to at some point release the hedge or one of the two legs. Now obviously the market causality, fair enough, it allows to do that. I mean, let's say for example the market switches into a very high buy situation, and you can predict with a high confidence what happens next. Of course then you can adjust your hedge, yeah. But if you really want to do that, if you want to trade that way, you need to trade with low leverage, yeah, and you need to split up your entries and all that, okay. You cannot use a lot of leverage, all right, and you know just not place a stop, then you will blow up eventually, okay. Now trading with stops is not easy, okay. It's not easy because you need to really know where you want to place your own stop. If you place it too tight, you will get stopped out all the time. If it's too far away, then the loss resulting from one trade is proportionally too high. So it needs to be kind of balanced. Your risk return needs to have at least some balance. Now sometimes in the short term you see a trade and the risk return is below 1. That doesn't mean that you need to skip this trade, because in the market causality we sometimes see high confidence trades which will work like 8 out of 10 times. So even if the risk return is not optimal, you may be able to take it. But you can't move your stop, okay? You should calculate your lots as the output of where the distance of the stop is, and subject to how much percent per risk per trade you actually want to risk. And then again, of course, you should make a checklist. If the trade has these minus points, you need to reduce the maximum risk per trade you're willing to put down, of course, yeah? So these are basically the two alternatives, okay? I do not recommend anyone to trade without stops. I know some people do that, but just be aware. Do not fool yourself by thinking that, you know, oh yeah, I didn't get stopped out, and most trades eventually come to some target. This is just too dangerous, yeah? The market can run away thousands of pips, no problem. We've seen it. Yeah, you can get caught in a squeeze and then it just runs away. Of course, some people they do, like, let's say, mental stops, and they have the ability, if they see for example, the market causality does a complete money switch, they don't wait a second, they immediately switch their position. Okay, that's fine. If you have such a strong mindset, it may be feasible, but you can't hesitate. Yeah, if you see that you're on the wrong side of the market, you need to act, even if it implies that you need to trade at bad prices. Now, all trading approaches, styles, systems come down to those numbers, really, okay? The win-loss ratio, how many trades are profitable, how many are losing, yeah? The risk-return ratio, on average, how much per trade do you risk or lose, and also the maximum numbers of those trades. Of course, you should add trade frequency, yeah, because this factor is important. If you have a system which doesn't give many trades, you know, then, you know, often the return can be limited. But if you are over trading, you know, like, the risk can be too high overall, yeah, even if you use stops. You know, because if you can't reach a high win-loss ratio, you may still lose overall. Yeah. So keep in mind that, you know, these are really the relevant factors, and whether it's a scalping approach, high frequency, or trend following, low frequency, whatever, yeah, these numbers need to be under control. Of course, if you have a balanced approach, a balanced system, which has some drawdown, then of course it's relevant how is the drawdown distributed. Okay, does it come over 2 months? Okay, once a year, twice a year? You know, these are relevant factors. What's the maximum drawdown, etc. So to generalize some of the trading rules, at least, okay, always use a stop or hedge. All right, that's my recommendation. Calculate the lot size based on the pip distance of the stop and the maximum risk per trade. Okay, reduce the risk per trade if the trade is not optimal. Okay, as simple as that. The more you practice with the market causality, the easier that can be done. As you can imagine, these days it takes me a split second to see, oh, these are minus factors. I decrease my trade size. Be selective. This is very important for any trading, really. You need to be selective. Some people, they like to trade in a very purist manner. I think that's a good idea. Yeah, just stick to the really easy trades where you have an edge and you know that in 8 out of 10 times you will make money. Yeah, the rest just gets stopped out and overall you will make money. Do not do these things here. Yeah, the beginner mistakes, revenge trading. You get stopped out, you place another trade to make the money back. Never ever do this. Have realistic expectations. Okay, do not try to double your account in 3 months. That won't end well because you're risking too much. Don't do that. Okay, come up with reasonable numbers. Try to limit your drawdown. Okay, discipline, patience. Again, this is important. This is necessary in this game. All right, this is a given. And don't chase your P&L. Do not overtrade, etc. Okay, so remember, if you trade without stops and you still insist on high leverage, even with a high win-loss ratio, if you get on the wrong side of the trade just once and you don't do anything, you just look at the screen, this is equivalent of selling an option. The downside is unlimited. Don't do it. Don't blow yourself up. Now, trading with stops on the hedging is not easy. Okay, as I said before, you need to know what you're doing, but it's necessary. And I will go a bit more into detail now. Like, we know exactly where you place the trade. Let's say here you want to sell. Of course, place your stop above the counter stops and above all the longies, so that in order for you to get stopped out, these longies would need to get into profit, which happens very rarely. You understand? Our guys and our girls, they know where to place the stops because you can see where the money is and the stops where they are. Okay, and of course it feels a bit different. Like beginners, you know, they make trades, stop out, get stopped out. They directly look for another trade. They take a trade they shouldn't take. They get stopped out again. Now they are depressed. They increase their risk per trade. They chase the P&L, and everything becomes a downward spiral. Yeah. Whereas the professional trader, he gets stopped out. He waits patiently for the next good trade. He trades like a robot, you know? He doesn't get provoked. If there's a slow day, there's a slow day. He doesn't try to force any trade because he knows that the next phase of good trades is just around the corner. And if you see the market causality, all you need to do is to wait for the right setups. And they come eventually, as you know. Sometimes we have a waterfall of profits just because there's an easy market phase and, you know, you can pick easy trades and make easy pips. That's when you score. When things get complex, then, you know, you keep it low. Okay, common sense really, isn't it? Okay, so the importance of stops is because, you know, not a single trade can just blow you. You know, if there's maybe a sequence of trades and overall you lose, fine, you can still, you know, come back, but, you know, you don't blow up. And as I said before, okay, use a pip calculator. Sorry, lot calculator. Okay, say here I want to place my stop. Let's say you want to buy cable, and, you know, below the price of 40 pips there's like, you know, like a position nest of the shorties, so you add another buffer of maybe 20 pips, you know what I mean? So you have like a 60 pip stop loss below the position nest, and then you look for a target around the same number, yeah, for example. And then you say, look, the trade is good, but 1, 2, 3 against it. We have some stops on the counter side. We have some longies in the way. Okay. You go to a maximum risk per trade. Let's say it's 0.5%. You subtract. It's maybe 0.3%. So you have the distance in pips. You have the 0.3% of the account you want to risk on that trade. And then you calculate how many lots you can place and you round it down. Okay. You always round down, not up. And if you make those trades and you're good in your analysis regarding the market causality, you will over a sequence of 50, 60, 70, and then later 200, 300, 400, 500 trades, and later 2,000, 3,000, 4,000 trades, you will make money, and this edge will materialize into pips and therefore into cash on your account. As simple as that. But you just do it day in and out what you have to do. Okay, you're not gambling. We are trading, not gambling. Okay, that's very important. Gambling is the opposite of trading, the opposite. Okay, we are exploiting a statistical edge and we are limiting our downside. We are not looking for a home run or just placing trades in the market, even in high confidence situations where we know that in 90% of cases we know euro dollar will go down 40 pips. Even then we stay disciplined and we don't bet the house on a single trade. Okay, and then look, you have different days, and some days you get stopped out, on others you make some money. The trades which lose money, they're the cost of doing business, really. You see, it's about the net, how much on the net basis after all trades are closed, after your risk is on your account. That is the actual profit. Okay, it's all subject to risks, and as I said, do not blow up. Yeah. So I hope you liked that one. I don't want to make this presentation too long neither, but I will do another one in the future where I go a bit more into detail regarding risk management and stops and all that. But please, okay, first of all, do not say these wrong statements. Okay, FX trading is not just about discipline, otherwise all bots would make money, because the bots, they have 100% discipline. And it's not only neither about just having the edge. If you can predict 85% of price moves, if you do not have anything in place which protects you from the rest of the trades which are going against you, you will blow up. Okay, so you need both components. All right, you need to get so good that you can forecast moves consistently and increase your win-loss ratio. I've done that. I've shown that. I've documented that here on YouTube. At the same time, you need to have a control in your risk in whatever way you prefer. If you are okay with stops, you stops. Make sure your risk return has some balance. Sometimes you may hit a very good risk return. Okay, then take the trade. Sometimes it's not so good, but you're very confident on the trade. You may still take it as long as you make sure that overall you're very selective. Yeah. Or if you want to do it the hedging way, also like I did back in the days. These days I like stops more. But I used to do a lot with like multiple entries and hedging. But then, if you see that out of 10 trades you get caught in a dumb money switch, okay, 1 or 2 times, do not hesitate, okay? Hedge, all right? And do not gamble, okay? As simple as that. All right, I hope you liked this quick reminder. I wish you all the best. Happy trading. Goodbye.